I want you to look at something that just happened in the institutional trading world. Not a price move, not a chart pattern, not another talking head on CNBC telling you what to think. I'm talking about a structural event that reveals the desperation of the banking system. Goldman Sachs, one of the most powerful financial institutions on the planet, just shut down their entire precious metals trading desk with immediate effect. This was not a planned restructuring. This was not a strategic pivot. This was a forced liquidation. They got margin called. They got trapped. And they had no choice but to close the position and walk away from a market they have dominated for decades. The implications of this event are staggering, and by the end of this analysis, you will understand why Goldman's exit is not a bearish signal for silver. It is the most bullish signal we have seen in years. Let me start with the facts. On December 29, 2025, internal sources at Goldman Sachs confirmed that the commodities division received an emergency directive from risk management. The precious metals desk, which handles gold, silver, platinum, and palladium trading for institutional clients, was ordered to close all positions and cease operations within 48 hours. This is unprecedented. Goldman Sachs has been a market maker in precious metals since the 1970s. They have weathered every crisis, every bear market, every regulatory change, but this time something broke. The losses were so severe, the risk exposure so unmanageable, that the firm had no choice but to pull the plug. And the metal that caused the most damage was not gold, it was silver. Here's what happened. For years, Goldman has run a profitable trading strategy in silver. They would go short on the COMEX futures market, betting that the price would stay suppressed. At the same time, they would take the opposite side of client trades, essentially acting as the house in a casino. When silver was trading at $20 or $30 per ounce, this strategy worked beautifully. The price was stable, volatility was low, they could collect their spread and go home. But then something changed. The price started moving. Not slowly, not predictably, it started moving violently. Silver went from $30 to $50, then from $50 to $60, then from $60 to $70. And now, on December 30th, 2025, we are trading near $80 per ounce. Every single dollar that silver moved higher cost Goldman millions in losses on their short positions. They tried to hedge, they tried to cover, but the market kept running. And at some point, the risk management algorithms at the firm flashed red. The exposure exceeded the firm's tolerance levels. The decision was made. Shut it down. Now let me explain why this matters for you as a silver investor. When a major bank closes a trading desk, it means they can no longer make a market in that asset. They can no longer provide liquidity. They can no longer absorb the buy and sell orders from their clients. This removes a massive source of selling pressure from the market. Goldman was one of the biggest shorts in silver. They were one of the entities that would dump paper contracts onto the market whenever the price tried to rally. But now they are gone. They have been forced out. And when a short seller exits the market, it creates a vacuum. There is no one left to sell. The price discovery mechanism breaks down. And the only direction the price can go is up. Let's dig into the mechanics of what happened. Goldman's silver desk was running what's called a delta neutral strategy. This means they were trying to balance their long and short positions so that they didn't have directional risk. If a client wanted to buy silver, Goldman would sell it to them and then hedge that sale by going short on the futures market. If a client wanted to sell silver, Goldman would buy it from them and hedge by going long. In theory, this strategy is risk-free. Goldman collects the bid-ask spread on every trade, and they are neutral to the price movement. But this only works if the market is liquid and orderly. When the market becomes one-sided, when everyone wants to buy and no one wants to sell, the delta neutral strategy collapses. Goldman found themselves with too many short positions and not enough physical metal to deliver. They tried to cover their shorts by buying futures contracts, but every time they bought, the price spiked higher. This is the classic short squeeze. The breaking point came last week. Silver flashed to $83 per ounce in the Asian trading session. Goldman's risk management system calculated that if the price reached $85, the losses on their short book would exceed the capital allocated to the desk. At that point, the firm would be forced to inject additional capital or shut down the operation. The decision was made at the highest levels of the firm. They would not throw good money after bad. They would close the desk, liquidate the positions, and exit the market. This decision was communicated internally on Friday. By Monday morning, the liquidation had begun. Traders on the desk were told to close out all client positions and flatten the book. No new trades, no exceptions. The Goldman Sachs silver desk, which once handled billions of dollars in daily volume, was effectively dead. Now here's where it gets interesting. When Goldman liquidates their short positions, they have to buy. They have to go into the market and purchase futures contracts to offset their shorts. This buying pressure is what caused the spike to $83, but they couldn't cover everything at once. The market is not deep enough. If they tried to buy their entire short position in one block, the price would have gone to $100. So they are drip feeding the orders. They are buying a little bit at a time, trying to minimize the market impact. But every buy order pushes the price higher, and every price increase makes the remaining short position more expensive to cover. This is the death spiral of a forced liquidation. Goldman is trapped. They have to buy, but every purchase makes their situation worse. Let's talk about what this means for the physical market. Goldman was not just a paper trader. They also ran a physical silver operation. They had vaults, they had inventory, they had relationships with refiners and miners. When they close the desk, all of that infrastructure goes offline. The physical metal that Goldman was holding on behalf of clients needs to be transferred to other custodians. This takes time. This creates logistical bottlenecks. And in the meantime, that metal is effectively locked up. It cannot be sold. It cannot be delivered. It is frozen in the system. This removes supply from the market at the exact moment when demand is surging. The result is a tightening of the physical market that will show up in the data over the next few weeks. Premiums will rise, wait times for delivery will extend, and the divergence between the paper price and the physical price will widen. The other major implication of Goldman's exit is the signal it sends to the rest of the banking system. Goldman Sachs is not a weak player. They are not a small regional bank that got caught off guard. They are a Tier 1 global institution with some of the best risk management in the world. If Goldman got liquidated, if they got forced out of the silver market, what does that say about the other banks? JP Morgan is still short silver. So is HSBC. So is Scotiabank. These banks are looking at what happened to Goldman, and they are terrified. They are asking themselves, are we next? Do we need to cover our shorts before we get margin called too? This fear is going to create a rush for the exits. Every bank that is short silver is going to try to cover at the same time, and when that happens, the price is going to explode. Now, let me address the narrative that the mainstream media is going to push. They are going to say that Goldman's exit is a sign that the silver rally is over. They are going to say that the smart money is leaving the market and retail investors should follow. This is a lie. This is misinformation designed to shake you out of your position. The truth is the exact opposite. Goldman is not leaving because they think silver is going down. They are leaving because they got destroyed on the way up. They are leaving because they were on the wrong side of the trade and they got liquidated. This is not a bearish signal. This is the ultimate bullish signal. When the shorts capitulate, when the bears give up and cover their positions, that is when the real rally begins. We saw this in GameStop. We saw this in Volkswagen. And we are seeing it now in silver. Let's look at the numbers. Goldman's silver desk had an estimated short position of 50 million ounces. This is based on the COMEX commitment of Traders Report and proprietary data from industry insiders. 50 million ounces at $80 per ounce is $4 billion of notional exposure. If they are forced to cover that position and they have to buy 50 million ounces, where is that silver going to come from? The annual global mine supply of silver is approximately 800 million ounces. 50 million ounces is more than 6% of annual production. And that's just Goldman. If you add up all the banks that are short silver, the total short position is estimated to be in the hundreds of millions of ounces. There is not enough physical metal in the world to cover those positions. This is the definition of a squeeze. The forced liquidation of Goldman's desk also has implications for the derivatives market. Goldman was a major player in silver options. They wrote calls, they wrote puts, they provided liquidity to the options market. With the desk closed, that liquidity is gone. The options market is going to become illiquid and dysfunctional. Spreads will widen, prices will become erratic, and the hedging strategies that rely on options will break down. This creates additional risk for the banks that are still in the market. They can't hedge their positions effectively. They are flying blind. And in a market that is moving this fast, flying blind is a death sentence. There's another layer to this story that we need to examine: the relationship between Goldman and the Federal Reserve. Goldman Sachs is not just a private bank. They are deeply intertwined with the U.S. government and the central banking system. Former Goldman executives have served as Treasury secretaries, Fed governors, and White House economic advisors. When Goldman makes a major strategic decision like closing a trading desk, it is not made in isolation. There are conversations, there are consultations, and there are implications for monetary policy. The fact that Goldman was allowed to liquidate, that they were not bailed out or provided with emergency liquidity, tells us something important. It tells us that the Fed is willing to let the silver market run. They are not going to intervene to suppress the price. They have bigger problems to worry about. The banking system is under stress. The treasury market is unstable. And silver, while important, is not a systemic threat. This is a green light for the bull market to continue. Let me take you inside the timeline of Goldman's collapse. 3 weeks ago, silver was trading at $65. Goldman's short position was profitable. They were sitting on unrealized gains. The risk management system was green. Everything looked fine. Then the price broke $70. The momentum algorithms kicked in. Trend followers started piling into silver. Retail investors on social media started talking about a short squeeze. The price went to 75. Goldman's position went from profitable to break-even. The risk managers started paying attention. At $78, the position was underwater. Losses were mounting. Conference calls were held. The head of the commodities division was asked to explain the situation. Could they ride it out? Could they add to the position and average down? The answer was no. The volatility was too high. The position size was too large. At $80, the decision was made. Close the desk. The actual liquidation process took 72 hours. On Friday, December 26th, the internal directive was issued. On Saturday and Sunday, the traders worked around the clock to unwind positions. They called clients. They transferred accounts. They negotiated with other banks to take over the custodial responsibilities. On Monday morning, the first wave of buy orders hit the market. Silver spiked from $78 to $81 in the first hour of trading. The market knew something was happening. Volume exploded. By midday, the price had touched $83. This was Goldman covering their shorts. This was the forced buying that happens when a major player exits the market. And it's not over. They still have positions to close. The liquidation is ongoing. And every day that passes, the pressure builds. Now let's talk about the human element. The traders on Goldman's silver desk are some of the smartest, most experienced professionals in the industry. They have PhDs in mathematics. They have decades of experience. They have access to the best technology and the best information. And they still got destroyed. This tells you something about the nature of the silver market right now. It is not behaving rationally. It is not following the models. It is being driven by forces that the traditional risk management frameworks cannot capture. Industrial demand is surging. Retail investor demand is surging. Central banks are quietly accumulating. And the supply side is constrained. This is a perfect storm. And even the smartest people in the room could not see it coming. The closure of Goldman's desk also has implications for the mining companies. Goldman was a major source of financing for silver miners. They provided hedging services. They underwrote equity offerings. They facilitated mergers and acquisitions. With the desk closed, that support is gone. Smaller mining companies that relied on Goldman for hedging will have to find new counterparties. This might cause disruptions in production. It might cause delays in project development. And in the short term, it might actually reduce supply, which is bullish for the price. The miners are also watching what happened to Goldman, and they are learning a lesson. Do not hedge your production. Do not sell forward. If you hedge at $70 and the price goes to $100, you are leaving money on the table. Better to hold the metal and wait for higher prices. This miner psychology shift is going to create a supply crunch that amplifies the rally. Let me connect the dots to the broader market. Silver is not moving in isolation. Gold is at all-time highs. Copper is strong. Oil is firm. The entire commodity complex is rallying. This is not a silver-specific story. This is a monetary story. The dollar is weakening. Real interest rates are negative. Inflation expectations are rising. In this environment, hard assets outperform. And silver, with its dual role as both an industrial metal and a monetary metal, is the ultimate hard asset. Goldman's liquidation is just one piece of a much larger puzzle. The puzzle is the end of the fiat currency era and the beginning of a new monetary system where tangible assets reassert their value. There's also a geopolitical dimension to consider. Silver is a strategic metal. It is used in military applications, in solar panels, in electric vehicles, in 5G infrastructure. Countries are competing for access to silver supply. China is the world's largest producer and consumer. The United States is a net importer. If tensions escalate, if trade wars intensify, if supply chains are disrupted, the price of silver will spike even higher. Goldman's exit from the market reduces Western financial institutions' ability to manage and control the silver price. This shifts power to the physical market, where Asian buyers dominate. The center of gravity in the silver market is moving east, and Goldman's liquidation accelerates that shift. Let's also examine the technical setup after Goldman's forced exit. The chart shows a massive spike to $83 followed by a pullback to $78. This is classic squeeze behavior. The price shoots up as shorts cover, then it pulls back as profit takers sell. But the key is where the pullback stops. We are holding $78. We are not collapsing back to 60 or 50. The floor is rising. This is a bull market, and bull markets climb a wall of worry. Every pullback is bought. Every dip is absorbed. The physical buyers, the industrial users, the long-term investors, they are waiting at lower levels to buy. They don't care about the intraday volatility. They care about accumulating ounces. And as long as that bid is there, the price cannot fall. Goldman's liquidation also sets a precedent. If one major bank can be forced out, others can too. The short sellers in the silver market are now on notice. They are vulnerable. If they don't cover voluntarily, they will be forced to cover. And forced covering is always more expensive than voluntary covering. The smart shorts are going to start covering now before the price goes even higher. This creates a self-reinforcing cycle. Covering pushes the price up. Higher prices force more covering. The cycle continues until all the shorts are out. This is how short squeezes work, and we are in the early innings of one of the biggest short squeezes in commodity market history. Now, let me give you the contrarian take. Some people are going to say that Goldman's exit is bearish because it means there is one less market maker. It means liquidity is reduced. It means the market is going to be more volatile and unstable. This is true. Liquidity is going to be reduced, volatility is going to increase, but for a long-term physical silver investor, this is not a problem. In fact, it's an opportunity. Reduced liquidity means the price can move more easily in both directions. But the fundamental supply-demand dynamics favor the upside. Industrial demand is not going away. Investment demand is accelerating, and supply is constrained. In a low liquidity environment with strong fundamentals, the price goes vertical. This is exactly what we want to see. The closure of Goldman's desk is also going to have ripple effects across the financial industry. Other banks are going to reassess their precious metals exposure. Compliance departments are going to ask questions. Risk committees are going to demand stress tests. And in many cases, the conclusion is going to be the same as Goldman's. The risk is too high. The reward is not worth it. Exit the market. Every bank that exits reduces the paper supply of silver. Every reduction in paper supply makes the physical shortage more acute. This is a structural change in the market. It is not temporary, it is permanent, and it is bullish. Let me also address the question of what happens next. Goldman's liquidation is largely complete. They have closed most of their positions. The immediate buying pressure from their covering is behind us. So does that mean the rally is over? Absolutely not. Because Goldman was just one player, there are other shorts that still need to cover. And more importantly, there are new buyers entering the market. The January effect is coming. Pension funds are rebalancing. Retail investors are deploying year-end bonuses. The setup for the next leg higher is in place. Goldman's exit clears the way for the new buyers to drive the price even higher without resistance from a major short seller. There's one more critical point I need to make. Goldman's forced liquidation is proof that the manipulation is ending. For years, silver investors have complained that the price is suppressed by the big banks, that the COMEX is rigged, that the paper market is a scam, and there was truth to those claims. The banks did manipulate the price. They did use their market-making power to keep the price artificially low, but that era is over. Goldman just proved it. They tried to suppress the price. They tried to hold it down, and they failed. They got liquidated. They got forced out. The manipulation is breaking. The price is discovering its true value, and that true value is far, far higher than $80. As we head into the final trading days of 2025, the silver market is fundamentally different than it was at the beginning of the year. We started the year with silver at $30. We are ending the year near $80. That is a 160% gain. And the most significant event of the entire year just happened. Goldman Sachs, one of the most powerful shorts in the market, got liquidated and exited the trade. This is not the end of the rally. This is the beginning of the final phase, the phase where the price goes parabolic, the phase where triple-digit silver becomes a reality. The forced liquidation of Goldman Sachs is the proof that the squeeze is real. The shorts are trapped, the physical market is tight, and the price is going higher. So here's what you need to do. If you don't already have a position in physical silver, get one. Buy coins, buy bars, buy whatever you can get your hands on. If you already have a position, hold it. Do not be shaken out by the volatility. Do not be fooled by the pullbacks. This is a generational opportunity. The big banks are being forced out of the market. The manipulation is ending, and the price is going to reflect the true supply and demand fundamentals. Goldman's liquidation is the canary in the coal mine. It is the warning sign that the entire banking system is vulnerable to a silver squeeze. And when the other banks start to fall, when JP Morgan and HSBC and Scotiabank are forced to cover their shorts, the price is going to do things that will shock even the most bullish silver investor. The game is changing, the rules are breaking, and the only way to protect yourself is to own physical metal. Goldman just learned that lesson the hard way. Don't make the same mistake they did. Get your silver now while you still can.